Sweetgreen, the salad restaurant, is very popular. But is this stock a buy right now? Welcome to the Food Fund. We're diving deep into Sweetgreen after the disappointing earnings report. Can Sweetgreen bounce back? Or is its future as bad as its recent performance? If you own Sweetgreen, or you're thinking about it, you need to see this. Let's start with the hard truth. Sweetgreen's stock performance. Over the last year, you're looking at a horrific minus 72% CAGR. Zoom out to 5 years, and it's still bad, a minus 35% CAGR. This company has been struggling for a while. Market share is a key factor for food and restaurant companies, and may be the only positive for this company. The dashboard shows Sweetgreen is the second smallest fast food restaurant company, but it seems to be growing. Looking closer, they have 0.08% share of the market among public food, beverage, and restaurant stocks. Over the last 5 years, Sweetgreen's market share has actually compounded at 19%. They've gone from 0.047% in 2021 to 0.083% today. The trend is good. However, we can clearly see that the rapid growth petered out in the last year. This may mean trouble. When we look at the fundamentals, the story gets worse. Gross margin is just 19%. This is much worse than many of its peer restaurants. Revenue has grown at 22% over the past 5 years, now at $686.2 million. Again, growth has stalled since 2024. The cash flow also looks troubling. Operating cash flow flipped from negative to positive. CapEx worsened at a 2% CAGR. The result? Free cash flow has improved at an 18% CAGR but remains negative. The good news is that Sweetgreen is operating cash flow positive, so that means they could achieve independence from fundraising if they stop spending on expansion so aggressively. Weighted average shares outstanding have increased over time, going from 27.8 million shares in 2021 to 116.5 million shares most recently. Sweetgreen is diluting shareholders pretty aggressively. Next, return on invested capital. This tells us how efficiently management is investing in the company. From minus 62.4% in 2021 to minus 15.4% most recently, management has gotten more efficient over time, but the investments are still underwater. For operational efficiency, measured by the cash conversion cycle, Sweetgreen is actually doing a bit better. It went from 4 days to minus 8 days, showing good improvement in efficiency. Finally, debt. Net debt to EBITDA has fallen from 4.4 in 2021 to minus 3.5 most recently. Given that Sweetgreen is still unprofitable, this means the company's debt is growing while losses worsened. Now let's compare Sweetgreen's performance against the gold standard, the S&P 500. Investing $10,000 in Sweetgreen would have shrunk the investment to $4,025 compared to $13,991 in the S&P 500. That's an annualized return of minus 22.4% for Sweetgreen versus 9.8% for the S&P 500. Sweetgreen also showed much higher volatility and a larger maximum drawdown. Unsurprisingly, risk-adjusted returns, Sharpe and Sortino ratios, were much worse for Sweetgreen. Clearly, investors would have been better off owning the S&P 500 instead. Sweetgreen was founded in 2007 by 3 college students, aiming to create a healthier, more sustainable alternative to fast food. By specializing in fresh, made-to-order salads and grain bowls, Sweetgreen has built a loyal following of customers looking for quick lunch options. The company employs over 6,000 people and has its headquarters in Los Angeles, California. Despite the promising premise, Sweetgreen is clearly falling short. Based on my proprietary scoring system, I give Sweetgreen a 5 out of 10. Still, Sweetgreen may have a turnaround in its future. Before I share my final thoughts on that, if this analysis was helpful, please hit that like button to let YouTube know. It really helps the channel. And if you want more deep dives into food, beverage, and restaurant stocks, subscribe and ring the notification bell so you don't miss the next video. Your support means the world to the Food Fund. Also, don't forget to turn on your notifications if you are watching on a mobile device. So my final thoughts on Sweetgreen. Let's write it out in the spreadsheet. It is a restaurant company with a gross margin of 19%. The 5-year revenue per share CAGR is minus 19%, and the 5-year free cash flow per share CAGR is 46%. Even though free cash flow is improving, it is still negative. A return on invested capital of minus 15% is bad. Next, the cash conversion cycle of minus 8 days is very good and the best metric for the company. A net debt to EBITDA of minus 3.5 shows that the company is unprofitable with a sizable debt load. Now let's switch our attention over to valuation. The price to earnings growth, or PEG ratio, cannot be calculated because Sweetgreen is unprofitable. Sweetgreen was a fast-growing company, super popular with consumers, but growth is slowing. Q2 earnings failed to meet expectations. Revenue was $186 million versus $192 million expected, while earnings per share came in at minus 20 cents versus minus 12 cents expected. More worrisome was the downwardly revised guidance. Sweetgreen now expects full-year revenue to be between $700 million and $715 million. Same-store sales are expected to be down 4% to 6%. The future does not look rosy for the company. For now, I am staying away and making my salads at home. What do you think about Sweetgreen? Are you an investor? Are you buying the dip? Share your thoughts in the comments below. I always love hearing from you. Check out some more videos right now, and remember to put your money where your mouth is.